Emerging markets are under some pressure right now, and as we've seen time after time after time, markets tend to paint a broad brush over all emerging markets as if they're the same. They're very clearly not, and at the genesis of this particular drama is in countries that have large current account deficits, which is not the case for most of the markets where Standard Chartered operates, starting with China and most countries in ASEAN, and many of the countries in the Middle East and elsewhere where we operate. So, of course, there are pockets of concern within our footprint, and there's been an overarching and an overwhelming withdrawal of liquidity from emerging markets, which is what happens when the markets, I think simplistically, paint everything with the same brush. But the countries that have strong fundamentals, which certainly starting with Singapore, where we are right now, and the other markets in this part of the world, will navigate this bit of turmoil just fine, and will come out even stronger, I think.
Sitting where we are, though, do you think this drama that has already taken place, as you phrased it, will have a negative financial impact on your results in the current period?
Not in any direct way. I think the question becomes one of confidence and investment confidence. So, fundamentally, we finance trade and cross-border investment and facilitate trade and associated risk management. The risk management opportunities are strong right now. I mean, people are concerned about the way currencies are moving. So over some period of time, that becomes a stabilizing or good thing for business. And the lack of confidence eventually flows through to economic activity, flows through to investment activity, which could have some sort of a suppressing effect. But on balance, we see this as something that happens in the ordinary course of our markets. I think we've been through regular financial crises in the world and emerging markets crises. I don't put this one at the severe end of the spectrum by any means.
And what about in China? I mean, you mentioned, look at the fundamentals there. Right now they are strong, and that's so crucial as an anchor for emerging markets. Others have said, we're not so comfortable with the debt levels still in China. Now at a time where they're meant to be deleveraging, some concerns they may have to put some of those efforts on hold, in part because of what's going on in the trade tensions. Does that concern you if we were to see a big shift in the Chinese economy alone?
It would concern me if there was a big shift in the Chinese economy, although I don't see that coming. I think the Chinese have been very thoughtful about the way that they delevered in that period between 2017 and into early 2018, substantially cleaned up the shadow banking system and the associated wealth management products that were a source of some concern. Of course, there are high debt levels in pockets of China. There's also very high asset levels in China, from their foreign currency reserves to the ability for the population in China to absorb additional taxes, should that ever be necessary. And so I think on balance, the assets that China possesses are ample to deal with their liabilities. And I think they're very thoughtful about how they're approaching this period of economic questionability. I wouldn't say lack of confidence, but questionability. And they've got plenty of monetary and fiscal policy tools to deal with the short-term shocks.
Still watching? Perfect. Click here to watch another great video from CNBC International. Oh, and don't forget to subscribe. Thanks for watching.